Sarah is a 41-year-old project manager in a mid-sized American city. She has a stable job, a mortgage, 2 kids in school, and a retirement account she checks every few months. By every conventional measure, her life is financially normal. Not extravagant, not precarious, just normal. But in the past 6 months, something has shifted in ways she cannot quite name. Her grocery bill is $200 higher than it was 2 years ago for the same items. 3 of her closest friends have quietly mentioned they are carrying more credit card debt than they are comfortable with. Her company announced a restructuring last quarter. No one was laid off, but 2 positions were eliminated when people left and they were not replaced. Her mortgage renewal is coming up, and the new rate will increase her monthly payment by $340. Nothing is catastrophically wrong. Everything is slightly, persistently, undeniably worse. Sarah does not know the word for what she is feeling, but economists have a name for it. It is called the pre-crisis interval, the period before a major economic disruption becomes statistically visible in official data, but after it has already become materially real in the daily lives of ordinary people. History shows that this interval is not random. It follows patterns. And in March 2026, several of those patterns are present simultaneously in ways that deserve careful, honest examination. This video is not a prediction. It is a dissection. We are going to look at 7 specific signals drawn from economic data, historical precedent, and system-level analysis that suggest the next major economic crisis is not approaching. It has already begun its opening movements. Welcome to Global Economy Today. If this kind of honest, data-grounded economic analysis is what you come here for, the best thing you can do right now is make sure you never miss an episode, because the conversations we are about to have over the coming months matter more than most financial content you will find anywhere. Now let's examine the evidence. Before we begin, one framework is essential for understanding everything that follows. Economic crises do not begin on the day they are announced. They begin silently in the structural vulnerabilities of a system operating under increasing stress, weeks or months or sometimes years before any official body acknowledges them. In 1929, the fundamental weaknesses in the American banking system were visible to careful observers for at least 2 years before Black Tuesday. In 2007, the subprime mortgage deterioration was documented in specialist financial literature nearly 18 months before the mainstream financial press acknowledged a crisis was underway. In every major economic disruption in modern history, there was a pre-crisis interval during which the tremors were real, measurable, and systematically underreported. We are going to look at where those tremors are registering right now. Sign number 1, consumer credit stress reaching structural limits. In 2026, total U.S. consumer credit card debt has exceeded $1.3 trillion for the first time in history. Credit card delinquency rates, meaning balances more than 90 days past due, have risen to levels not seen since 2010, in the immediate aftermath of the last financial crisis. And crucially, this deterioration is happening while unemployment remains officially low and GDP growth remains technically positive. This combination is historically significant. In normal economic contractions, credit stress follows unemployment. People lose jobs, then fall behind on payments. What we are seeing now is the reverse. People are falling behind on payments while still employed. This means the stress is not primarily an income problem. It is a cost of living problem that has outpaced income growth for a sustained period until household balance sheets have reached a structural breaking point. Think of consumer credit like a pressure gauge on the economy's engine. When the gauge reads high, even when the engine appears to be running normally, it is not a sign that everything is fine. It is a sign that something inside the engine is running hotter than the external indicators suggest. In 1929, consumer installment credit had expanded dramatically in the preceding years. Automobile loans, furniture financing, appliance credit, creating a consumption base that looked robust until the underlying debt load became unsustainable almost simultaneously across millions of households. The structural parallel to 2026 is not perfect, but it is not comfortable either. Sign number 2, commercial real estate, the slow motion collapse no one wants to discuss. Here is a number that should be getting far more attention than it receives. In major American cities, office vacancy rates in 2026 are hovering between 18 and 25%, in some markets higher. This is not a temporary pandemic disruption that is resolving itself. It is a structural repricing of commercial real estate that is now 3 years old and accelerating, not stabilizing. The reason this matters, far beyond the real estate industry, is what it is doing quietly to the balance sheets of regional and community banks. Approximately 70% of all commercial real estate loans in the United States are held by banks with assets under $100 billion, the regional and community bank sector. When commercial properties cannot service their debt because their tenants have left and their valuations have collapsed, those loans become impaired. And impaired loans on bank balance sheets create a very specific kind of systemic risk. We have seen this movie before. In the late 1980s and early 1990s, the collapse of commercial real estate was the primary driver of the savings and loan crisis, a financial disaster that cost the U.S. government over $130 billion and resulted in the failure of more than 1,000 financial institutions. The mechanism was not dramatic. It was slow, quiet, and by the time it was visible to the public, it was already deeply embedded in the system. In 2026, an estimated $1.5 trillion in commercial real estate loans are scheduled for refinancing, at interest rates dramatically higher than when those loans were originally written. Many of these properties cannot support the new debt service. The loans will need to be restructured, extended, or written down. The banks holding them will need to recognize losses. The question is not whether this creates financial system stress. The question is how much, how fast, and how contained. Sign number 3, the unemployment number that doesn't tell the whole story. The official unemployment rate, the headline figure reported monthly and cited by politicians and financial media, measures the percentage of people who are actively looking for work and cannot find it. In 2026, this number looks relatively benign, but there is a different measure, the U6 unemployment rate, which includes people working part-time who want full-time work and people who have stopped looking for work entirely because they have become discouraged. That tells a meaningfully different story. The gap between U3 and U6 in 2026 is wider than it has been historically in periods described as full employment. Beyond the statistics, there's a qualitative shift in the labor market that the aggregate numbers obscure. Corporate layoff announcements in the technology, media, finance, and retail sectors have been consistent throughout 2025 and into 2026. These are not catastrophic mass unemployment events. They are targeted precision reductions in workforce that show up as manageable fluctuations in aggregate data while creating concentrated pockets of high-skilled unemployment that take longer to resolve than headline unemployment figures suggest. The historical pattern here is well documented. In the 12 months preceding both the 2001 recession and the 2008 financial crisis, official unemployment remained low even as layoff announcements accelerated and labor market quality, measured by factors like the ratio of full-time to part-time employment and the duration of job searches, deteriorated visibly. The headline number was the last indicator to move. By the time it did, the economic contraction was already well established. Sign number 4, the bond market sending signals the stock market is ignoring. There is an old saying among institutional investors, the bond market is the adult in the room. Stock markets respond to sentiment, narrative, momentum, and the psychology of crowds. Bond markets respond to fundamentals, cash flows, credit quality, default probability, and the structural soundness of borrowers. When they disagree significantly, history generally sides with the bond market. In 2026, there are points of tension between what equity markets are pricing and what credit markets are signaling that deserve careful attention. Corporate bond spreads, the premium investors' demand to hold corporate debt rather than risk-free government bonds, have been widening in certain sectors, particularly commercial real estate, retail, and leveraged buyout-backed companies. This widening means the bond market is demanding more compensation for default risk, a signal that professional credit analysts are seeing deterioration in corporate financial health that equity valuations may not yet fully reflect. The inverted yield curve, a condition where short-term interest rates exceed long-term ones, historically one of the most reliable recession predictors on record, appeared in the U.S. Treasury market in 2022 and persisted for longer than almost any previous inversion in the post-war era. Yield curve inversions have preceded every U.S. recession since 1955 without a single false positive. The lag between inversion and recession has historically ranged from 6 months to 24 months. The arithmetic of the current cycle is not reassuring. Sign number 5, global trade contraction and what it means. International trade is the circulatory system of the global economy. When goods move freely across borders, the system is healthy. When trade volumes contract, when the flow of goods slows, it is the economic equivalent of reduced blood flow. The organs of the global economy begin to feel the effects, often before any single measurement reveals the problem. In 2026, global trade growth has slowed significantly from its post-pandemic rebound trajectory. Containerized shipping volumes, which function as a real-time proxy for actual economic activity rather than financial market prices, have been soft. Manufacturing PMI, the Purchasing Managers' Index, which measures factory activity, has been in contraction territory in several major economies for extended periods. The geopolitical dimension amplifies this signal. The restructuring of global supply chains away from China, the fragmentation of trade blocs along geopolitical lines, and the rising use of tariffs and trade restrictions as instruments of political competition are creating friction in the system that has real costs. Costs that show up as higher prices, lower efficiency, and reduced economic output in ways that are distributed across every economy connected to the global trading system. Trade wars have economic precedent that is not encouraging. The Smoot-Hawley Tariff Act of 1930, passed at the worst possible moment as the post-crash economy was struggling to stabilize, helped transform a severe recession into the Great Depression by triggering retaliatory trade restrictions globally and collapsing international commerce. The lesson was so thoroughly absorbed by post-war policymakers that global trade liberalization became the organizing principle of the international economic order for the next 7 decades. That order is now under more stress than at any point since its creation. Sign number 6. Asset price inflation masking underlying fragility. In 2026, major stock market indices are trading at valuation multiples that, by historical measures, place them in the expensive range by virtually any metric. Price-to-earnings ratios, price-to-book ratios, the cyclically adjusted PE ratio developed by Robert Shiller that smooths earnings over a full economic cycle to reduce distortion. Here's the important nuance that most financial media fails to communicate. High stock market prices and a healthy economy are not the same thing. They can coexist, they can also diverge dramatically, and historically, periods of extreme valuation disconnected from underlying economic fundamentals have preceded corrections with a consistency that is difficult to dismiss. The mechanism behind this particular sign is the decade-long era of near-zero interest rates that preceded the rate hiking cycle beginning in 2022. When money is essentially free, asset prices inflate because the mathematical models used to value future cash flows assign them enormous present value. As rates rose, the theoretical underpinning for elevated valuations weakened. And yet prices in many cases remain elevated, sustained by momentum, by institutional allocation mandates, and by the reflexive belief that central banks will always intervene to prevent significant market declines. This belief, called the Fed put in financial markets, is not irrational given the history of the past 20 years, but it rests on the assumption that central banks have unlimited capacity and political willingness to support markets regardless of the inflationary consequences. In 2026, that assumption is significantly more questionable than it was in 2015. Sign number 7. The thing ordinary people feel first, purchasing power erosion. Return to Sarah from our opening scene, the $200 increase in her grocery bill, the $340 increase in her mortgage payment, the friends carrying more credit card debt, the job that technically still exists but feels less secure than it did 2 years ago. What Sarah is experiencing is the cumulative effect of sustained inflation on real purchasing power. And the specific way this particular economic sign is dangerous is that it operates slowly enough to feel like a new normal rather than an alarm signal, while compounding into structural economic damage that eventually forces a reckoning. Between 2021 and 2026, cumulative inflation in essential goods and services, food, housing, energy, healthcare, insurance, has significantly outpaced wage growth for the bottom 60% of earners. This means that the real standard of living for the majority of households has declined even during a period when employment was high and GDP was technically growing. The economy was producing more. Most people had less purchasing power with which to participate in that production. This divergence between aggregate economic statistics and individual lived experience is not a communication failure. It is a structural feature of an economy where the gains of growth have become increasingly concentrated at the top of the income distribution, while the costs, inflation, debt, reduced public services, have been distributed broadly. When this divergence becomes large enough and sustained enough, the political and economic pressures it generates eventually force a structural adjustment. That adjustment is rarely smooth. Historically, it is rarely called a crisis until after it has clearly become one. Here's where we land. 7 signals, none of them individually conclusive. Collectively, they form a pattern that economic historians recognize with uncomfortable familiarity, the fingerprint of a system under accumulating stress, heading toward an inflection point whose timing is uncertain, but whose structural logic is not. The philosophical conclusion that emerges from studying economic history carefully is this: crises are never truly hidden. The information is always there. The signals always exist. What varies is not the presence of the evidence, but the willingness to look at it clearly, without the distortion of wishful thinking, vested interest, or the simple human preference for reassuring narratives over uncomfortable truths. The people who navigated the major economic disruptions of the past century without catastrophic personal loss were not clairvoyant. They were not particularly lucky. They were simply willing to look at the evidence before the consensus had fully formed, and to make quiet, deliberate decisions while the window for making them was still open. That window, historically, is never as wide as it appears, and never as closed as it feels once it is shut. If this analysis gave you something to think about, share it with someone in your life who is paying attention to these questions. That is how this kind of information reaches the people who need it most. And if you want to keep following this kind of honest, data-grounded analysis of where the global economy is actually headed, you already know where to find it. I will see you in the next one.